Hi. So today we'll discuss the key highlights of budget 2025. So as you all know, I'm a chartered accountant from Hubli. So I have been taking so much of time to come up with this video because I was analyzing each and everything. We are not like the WhatsApp University people wherein we just see everything upper say and we get it to our clients or maybe to the public. We are professionals. We take time. We read the finance bill. We read the memorandum explaining what are the provisions contained in the finance bill. We also read each and every document, what is the current scenario, what are the amendments and what is the impact of those amendments based on the transactions and the things. So not everything mentioned in the budget speech is the reality. There are things beyond that which we need to read and understand. So in this short video, I'm trying to analyze a few key highlights of the budget 2025, which was presented by Nirmala Sitharamanji on 1st of February 2025. Okay, without wasting much time, let us start with the discussion. So these are the few contents which we'll discuss today: personal tax rates, changes in TDS and TCS, salary and house property income, what are the changes in the income tax returns, what are the changes in the capital gains, what are the changes in the deductions, business trust, charitable and religious trust, taxation of non-residents and international tax, transfer pricing, amalgamation or business restructuring, crypto assets and GST. We'll start with the hot favorite topic of everyone, wherein the Honorable Finance Minister in the budget speech said that there will be no tax liability for people who are earning 12 lakhs of income. So is it really true? Is it applicable to all the incomes that an individual earns? Let us try to understand. So before we proceed ahead, these are the slab rates applicable for the assessment year 26-27. That is for the financial year beginning on 1st April 2025. So from 1st April 2025, these are the tax rates applicable, wherein the basic exemption limit has been increased from current 3 lakhs to revised limit 4 lakhs. So up to 4 lakhs, there will be no taxation. So 4 lakh is the basic exemption limit, 4 to 8 lakh 5%, 8 to 12 lakh 10%, 12 to 16 15, 16 to 20 lakh 20%, 20 to 24 lakh 25%, and in excess of 24 lakhs if your income is there, only then you will be under the bracket of 30%. So if I take out the average for a person earning 28 lakhs of income, the average tax rate would be 15%. So these are the tax rates which are the as per the new tax regime. As you are aware, from the last 1 year, new tax regime is a default tax regime. So if I want to opt out from this new tax regime, that is 115BEC, then I need to fill up a form while filing my income tax return, and then I need to stick up with the old tax regime wherein the basic exemption limit is still 2,50,000 and the rebate, the maximum amount which would not be taxable to taxes, like liable to tax, is only 5 lakhs. So by default, the law has been structured in such a way that whatever permutation combination if we do, the new tax regime itself will be beneficial to us. Indirectly, the government wants to close down the existing old tax regime. So these are the personal tax rates. So these are applicable only to, so let us understand. So personal tax rates, so it is governed by section 115 BAC. So if you look at that section, this section is not applicable for all kind of assessees. It is only applicable to individuals, HUFs, AOPs. Again, cooperative societies are not covered in this because under the new tax regime, cooperative societies have a separate governing law. 115 BAC is applicable to BOI, body of individuals, and artificial juridical persons. So in short, this is not applicable to partnership firms, LLPs, private limited companies, or any other form of business entity. It is specifically applicable only to individuals, HUF, AOP, BO, and AGP. And even in the new tax regime, that is 115 BAC, the incomes which are taxable at special rates. So there are certain transactions which are not taxable as per the slab rates. They are taxable as the special rates. For example, long-term capital gain from the share market. So that income is taxable under section 112A. Short-term capital gains from the share market is taxed under section 111A. Other long-term capital gain is taxable under section 112. So there are specific tax rates given. For example, the short-term, like we in the coming slides we have those. So let us not go there. Let us try to understand what the section 115 BAC says. And if you are opting for section 115 BAC, the maximum surcharge applicable is only 25%, as against if you opt out of the new regime and if you choose the old regime, if your income is in excess of 2 crores, in excess of 5 crores, the surcharge applicable there is 37%. I repeat, if you are opting for the old regime and if your total income is more than 5 crores, the surcharge applicable is 37%. Whereas if you are opting in for the new tax regime, the maximum surcharge, even though if your income is more than 5 crores also, the maximum surcharge that is applicable is only 25%. Going ahead, standard deduction. As you all know, in the previous budget, that is budget 2024, Nirmala Sitharaman ji had increased the standard deduction limit from existing 50,000 to 75,000. This was done by Finance Act 2, which was announced in July 2024. So the standard deduction under the head salary was increased from 50,000 to 75,000. Again, that was specifically only for the new tax regime. Old tax regime did not get the benefit of this enhanced standard deduction. So this is also available only when you choose 115 BAC. Again, as said, since 115 BAC is giving you benefits which is not otherwise available in the old tax regime, they are taking away certain benefits from you as well. So very famous deductions under chapter 6A like ATC, ATD, none of these deductions are available under the new tax regime except for the following three. So following three, the listed ones which you can see on the screen, are the only deductions which you can get under the new tax regime. First one, ATJJAA, that is deduction in respect of employment of new employees. So there are certain conditions. If you meet them, if you are a tax audit case, a taxpayer, if you employ new employees, 30% of your new employee clause you can claim it under ATJJAA. That benefit you can still claim under the new tax regime. Proceeding further, there is something called ATCCD2, wherein employer contributes to the national pension scheme, or Atal Pension Yojana is what we generally call. So that benefit is still given under 115 BAC. I repeat, only the employer contribution is given. Again, very important point, there is no maximum cap. So employer can contribute up to 14% of salary. So 14% of salary, and salary for this purpose is basic plus DA if it is applicable, DA in terms. So again, as said, there is no maximum cap for this. So 14% can be any amount. Like you had certain limits like under ATC, it can be only 1,50,000. There is no such limit for ATCCD2. Second thing, the next question is, okay, if I have to invest in NPS, what happens if I withdraw that amount? So this is generally a question which has been asked. Now, to make you understand, if you opt out of the national pension scheme and if you completely withdraw all the amount standing at your credit from the NPS, then 60% of that income would be exempt and 40% will be taxable. When you opt out from the national pension scheme completely, if you withdraw all the money, then 60% would be exempt, 40% will be taxable in the year in which you withdraw that money. However, if you go for a partial withdrawal, wherein you don't close your NPS account, but you withdraw some part of the money from your NPS account, for that, again, we divide it into two cases. If you are a salaried employee and if you withdraw that money with a partial exemption, then salaried people, 25% of the withdrawal would be exempt, 75% would be taxable. If you are a non-salaried case, then full, whatever is the amount of withdrawal will be fully taxable. Again, to be very specific, ATCCD2 you can claim only when you are an employee. If you are self-employed, you can make deductions under ATCCD to the national pension scheme. However, you will not be able to get this benefit of ATCCD2 under the new tax regime. So this is another benefit which you can still claim if you are opting for new tax regime. Next one, ATCCH2. So ATCCH2 is the central government's contribution to the Agnipath scheme. So if you are into Agniveer, if you are an Agniveer and if the central government contributes some amount to your Agnipath scheme, then you can claim it as a deduction here. And last one is ATLA. Section ATLA is, these are the specific incomes for IFSCs, so International Financial Service Centers. So if you belong to IFSC, and you can claim this ATLA deduction. So giving a broad overview of the new tax regime, section 115 BAC. So it is only applicable to individual HUFs, EOP, BOI and AGP. Special rates income, 115 BAC benefit is not available. You special rates income get taxed as special rate only, and the maximum surcharge under 115 BAC is 25%. There is no 37% surcharge. And if you are opting for 115 BAC, the standard deduction under salary has been increased from 50,000 to 75,000. This was done by the Finance Act number 2 of 2024. That is in July 24 itself. This is not an amendment of this budget. This 75,000 was done in the previous budget only. Again, chapter 6A, except for these following four deductions, no other deductions can be claimed. First one, ATJJAA is allowed, ATCCD2 is allowed, ATCCH2 is allowed, ATLA is allowed. In that, if you are a salaried employee, you can take benefit of ATCCD2. Only if your employer agrees to contribute 14% of your basic and DA, if it is DA in terms, to the national pension scheme. Again, what happens if you withdraw that money? As said, if you're withdrawing it completely, 60% exempt, 40% taxable. On partial withdrawal, if you are a salaried employee, 25% would be exempt, 75% would be taxable. So this is a broad overview of section 115 BAC. Now I cannot directly jump into a conclusion that okay, if I'm opting for section 115 BAC, 12 lakh income is exempt. No, it doesn't work that way. Going forward, section 87A. Now here's the catch. Section 87A rebate is only applicable to resident individuals. So 115 BAC was applicable to whom? Individuals, HUF, AOP, BOI, AGP. But if you see 87A is only applicable to individuals, in that too specifically resident individuals. And rebate can only be claimed for incomes which are taxable at slab rates. As said, we'll discuss a couple of incomes which are not taxable at slab rates. For against those incomes, whatever is the tax liability, you cannot claim rebate under 87A. And there is a concept called marginal relief. What is the concept of marginal relief? Say, as an example, if my income is 12 lakhs, I will claim entire, assuming there are no special rates, everything is taxable at the slab rates. If my income is 12 lakhs, then I will not pay zero tax because of rebate under 87A. But what if my income is 12 lakh 10,000? The moment I cross my target of 12 lakh, the entire amount will get taxable as per the applicable slabs, and that taxable amount will come to 61,500. So in this example, what happens is my income is getting increased by only 10,000. So my income was 12 lakh, then it is getting increased by 10,000. My income is now 12 lakh 10,000. As the effect of this increase of 10,000 is resulting in my increase of liability. If income was 12 lakhs, my liability was zero. Now I have to pay 61,500 tax. So that this is something called wherein the increase in your liability is more than the increase in income. Your income is getting increased only by 10,000, whereas your liability is getting increased by 61,500. So in this case, the concept of marginal relief kicks in. What is the concept of marginal relief? Whenever the increase in tax liability is greater than the increase in income, you get this marginal relief. In this case, what will happen now? In my example, whatever is the excess amount which I have earned over and above 12 lakh, 12 lakh 10,000 was my income and 12 lakh was the limit. I have earned 10,000 more. So that exact 10,000 will be my tax liability. I hope you understand. So whatever I earn over and above 12 lakh, that itself I should give to the government as tax. I need not give entire 61,500. So what is the limit, sir? Till what extent I can claim that marginal relief? This marginal relief can be claimed up to an income of 12 lakh 70,000. So if you earn 12 lakh 50,000, only 50,000 plus cess is what you need to give to the government. If you are earning 12 lakh 40,000, only the excess of 12 lakh, that is only 40,000 you need to give to the government. But if you are earning more than 12 lakh 70,000, in that case the entire slab will get applicable. I hope this is clear. So marginal relief concept is also available only under the new tax regime. The same is not available under the old tax regime, where the rebate limit is also 5 lakhs. So there is no concept of marginal relief, but under the new tax regime, there is a concept of marginal relief on the rebate component. In short, what is the takeaway? If your income crosses the limit of 12 lakhs marginally, just by few thousands, and as a result of that, your increase in liability is more than your increase in income, in that case, you can claim marginal relief. And what is the maximum limit? What is the amount that you need to remember? You need to remember an amount of 12 lakh 70,000. So up to 12 lakh 70,000, if you earn over and above what is your amount you are earning about 12 lakh, only that you can give it as a tax. There is no need to do slab calculation. Whatever is the amount you are earning, for example, if your income is 12 lakh 40,000, only 40,000 plus 4% cess is what you need to pay to the government as a tax liability and discharge it. No need to pay all the calculations, because up to 12 lakhs if you do, the slab is coming to 60,000. No need to give 60,000 to the government. Again, 87A rebate is only for resident individuals, only for the incomes taxable at slab rates. And marginal relief is available. Marginal relief ka upper limit is only 12 lakh 70,000. Let's move ahead. So going forward, now we discussed that under section 115 BAC also and under section 87A also. Special rates incomes are taxable as special rate is what I mentioned. So what do you mean by special rates income? So again, I'll divide it into two. First one, special rates income, which we normally call as casual incomes. So casual incomes are those incomes which you don't earn in the ordinary course, like for example, lottery income, card games, royalties, online games, transfer of cryptocurrency, and whenever the assessment happens, the government comes and they do your assessment, and some incomes which you had not disclosed get disclosed. So these are all special rates of income which attract special rates of tax. For example, as you are aware, lottery income gets taxed at 30% plus 4% education cess. So all these incomes will not qualify for 115 BAC. Second point, none of these incomes will qualify for rebate under 87A. And additionally, even the basic exemption limit of 4 lakh is not applicable for these kinds of income. I repeat, for these casual incomes, neither 115 BAC will be applicable, nor 87A rebate you can claim, nor you can claim the benefit of basic exemption limit. What is the impact of this? The impact of this is that even though I earn 1 lakh from the lottery, 1 lakh is less than the basic exemption limit, and 115 BAC if I calculate, it would be 0. 87A rebate is also applicable up to 12 lakhs, but still if I earn 1 lakh as a online lottery income, or say online income, say from transfer of cryptocurrency, then 30% would be my tax. So I cannot say that up to 12 lakh all incomes are exempt. No, all incomes are not exempt. Casual incomes or incomes which are taxable at special rates, they will be taxable. Specifically, the ones which I have listed above, those incomes are taxable on a gross basis. For example, I won a lottery of 1 lakh and I had spent 10,000 to get that lottery, to purchase that lottery. So only the remaining 90,000 should have been taxable, right? But the answer is no. In this case, the entire gross receipts of 1 lakh will be taxable. Again, against this income, no deductions are allowed, no expenses are allowed, no chapter A deductions are allowed, and of course, as said, no basic exemption limit is also available. So if I earn 10,000 from online games, then 3,000 would be straight away my tax, 3,000 plus 4% education cess. So there are certain incomes, even though which are beyond, like below 12 lakhs, below 4 lakhs, even though your incurred expenses, even though you have some chapter 6A deductions, these incomes are taxable. So you have to pay tax on these incomes even though if your total income is less than 12 lakhs. Now there is a second set of special tax incomes. So what is the difference? The first set which I discussed was special tax rate, which we casually call them as casual income. So again, coming to these set of incomes, these are also special rates of income, but these are not casual, right? So these are non-casual incomes. So the most famous ones are section 112A. Section 112A is nothing but long-term capital gain on from share market. So if you sell any shares or mutual funds or any security, listed securities, in that case, if the period of holding was more than 1 year, then it gets taxable under section 112A. Now again, this capital gain would be taxable only in excess of 1.25 lakhs. So up to 1.25 lakhs, if you have earned any long-term capital gain, it is not taxable. Only in excess of 1.25 lakhs, it gets taxable at the rate 12.5%. Again, just for your knowledge, this 12.5% rate prior to July 2024, 23rd July 2024 to be very precise, was 10%. So from the budget 2024, this rate was increased from 10% to 12.5%, and the limit of 1.2 lakhs was also earlier 1 lakh. So, but against this also there is no chapter 6A deduction allowed. 87A rebate is also not allowed. Be mindful, my friends, 87A rebate is not available against your long-term capital gains. Also, there is one benefit given to you. Suppose if you don't have any other income, this is the only income you have. You have a basic exemption limit of 4 lakhs. You can utilize that unexhausted basic exemption limit. Say for an example, I have 7 lakhs of, say 8 lakhs of what? Capital gains. In that, 4 lakh was my basic exemption, which is still there. I don't have any other income apart from this. So out of that 7 lakhs, I set aside this 4 lakhs, and 1.25 lakhs I set aside as a standard deduction. Only over and above this 5.25 lakhs, I pay tax at the rate 12.5%. Even though my total income as a whole was less than 12 lakhs, but only because these are special rates, special tax rates, then I have to pay tax at the rate 12.5% over and above 1.25 lakhs. Again, Chapter 6A deductions not allowed, 87A rebate is also not allowed. However, you can make use of the unexhausted basic exemption limit. Again, this benefit of using the unexhausted basic exemption limit is available only for resident individuals and HUFs. For no other entity, this benefit is available. And to be very frank, the basic exemption limit is available only to these assessees: individual, HUF, AOP, BO, and artificial juridical person. For any other assessee, this basic exemption limit is only not there. Flat income gets taxable for other kind of entities. Moving forward to section 112A. 112A is again share market income from short-term capital gains. If you have sold any securities, any mutual fund listed in the stock exchange, and you had purchased them within a period of 1 year, so the holding period was less than 1 year, in that case they'll get taxable at the rate 20%. Again friends, please remember, prior to Finance Act 24, this limit was only 15%. This tax rate was 15%. Now they have increased the tax rate to 20%. Again, against this, Chapter 6A is not allowed. A rebate under 87A is not allowed. However, you can take the benefit of unexhausted basic exemption limit. So even if my income, so say for an example, I have earned 10 lakhs as a short-term capital gain and I don't have any other income, then 4 lakhs basic exemption limit I can claim. Here there is nothing called basic exemption limit. Like in long-term capital gain, we had 1.25 lakhs, but in short-term capital gain, gross income, like entire this one gets taxable, entire gains gets taxable. I hope this is clear. And the tax rate is 20%. Even though my income was less than 12 lakhs, 10 lakhs was my gain, 4 lakhs was the unexhausted basic exemption limit. So on the remaining 6 lakhs, I have to pay tax at the rate 20% plus applicable cess, that is 4%. Coming to other long-term capital gains, section 112. So other capital gains are those gains which are not covered under section 112 and 311. Basically your sale of gold, sale of plot, sale of commercial property, sale of residential property, sale of urban agricultural property, any other capital assets which gets sold and the holding period was more than 2 years in case of immovable property. In that case, it gets taxed under the head under section 112 and the tax rate applicable is 12.5%. Again friends, be mindful, prior to Finance Act 2024, July 2024, this rate happened to be 20%. So government has given a benefit of reducing this tax rate from 20% to 12.5%. So transfer of any other long-term capital asset which you had held for more than 2 years, then it gets taxed under 112. Again for this, Chapter 6A is not allowed and 87A rebate is not allowed. What does it mean? It implies that even though my income from sale of long-term capital asset is less than 12 lakhs, then I still have to pay tax. However, the basic exemption, unexhausted basic exemption limit is still available to resident individuals and HUF. One more thing, just to drag your attention, even though this is not from budget 2025, it was from budget 2024 itself, the government had taken away indexation benefit. However, for individuals, for resident individuals and HUF, an option is given for tax payment. Either they can pay 20% with indexation or 12.5% without indexation. Only for resident individuals and HUF. Only if the property had been acquired before 23rd July 2024, before the budget date, very precisely. In all other cases, indexation benefit is gone, and even for these cases, this indexation benefit is only available at the time of calculation of tax liability, not at the time of calculation of capital gains. Be mindful, because this will have an impact in calculating your capital gain, and it is a very technical discussion. If you are dealing with these cases, maybe you can personally connect. So if I had to proceed ahead, so the combined reading of section 115 BAC read with section 87A read with the special rates, what we conclude? Sir, Nirmala Sitharaman said up to 12 lakhs, no tax. Is it true? Yes, it is true to a certain extent, as long as your incomes are normal incomes which are taxable at normal rates. However, if the incomes are taxable at special rates, in some cases it is taxable, and in any case the casual incomes get taxed even though they are less than 4 lakhs. Other incomes, even though if they are 12 lakhs, less than 12 lakhs, it gets taxable. The examples are long-term capital gain from share market, short-term capital gain from share market, and sale of other long-term capital assets. Sir, what about short-term capital assets? Short-term capital assets are taxed at slab rates, and if they are taxable at slab rates, if it is up to 12 lakh, I can claim 87A rebate. In that case, I need not pay any tax. So what is the summary, sir? To what extent what Nirmala Sitharaman said is true? Let us conclude. So if I have to see, sir, maximum till what extent of salary I can have a salary of maximum 14,43,000 and I can pay zero tax. If you ask me how, as said, 80cc2 benefit is available, right? So what I'll do, I'll include that as a part of my salary, 14%, 75% standard deduction would be there. So 14,43,000 minus whatever 14% of basic gets contributed as NPS minus 75% standard deduction. So even if I have 14,43,000 of salary with the assumption that 80cc2 is a part of my salary structure, then I need not pay any tax. Coming to rental income. Sir, what is the maximum rental income that I can have and I pay zero tax? Sir, the answer to your question is if you have 17,14,285 rupees, you you can pay zero tax because 17,14,285 would be your gross income, out of which 30% standard deduction is allowed under new regime also. So if you take out the standard deduction of 30%, your net taxable income would be 12 lakhs. Coming to business profession, sir, I run a business and all my more than 95% of my receipts and payments are through the banking channels only. What is the turnover limit? Sir, for you the turnover limit is 2 crore. So if you run a business and more than 95% of your total receipts and total payments are in digital mode, in banking mode, including UPI. So even if you have up to 2 crores of tax, you can straight away declare 6% as profit, 6% comes to 12 lakh, you can pay zero tax. Suppose if more than 5% of your total receipts or payments are in cash, more than 5% if you're dealing in cash, your limit becomes 1.5 crore, because 1.5 crore you declare 8%. So 8% comes to 12 lakhs. So up to 12 lakhs you pay zero tax. Now if you are a professional, what is the limit applicable to you? For you, the gross receipts up to 24 lakhs will attract zero tax. So these are the broader limits which you can confidently say that, okay, if I have this subject to the condition that you don't have any special rates income or you don't have any other income. So if you have any other income, then again marginal tax would be applicable. Say for example, with this tax I got a interest income of say 15,000. In that case my again total income will get increased by 15,000. In that case 87A rebate would be there, but subject to the marginal relief. So 15,000 you give to Nirmala Sitharaman, take the marginal relief, you need not pay 60,000 plus tax, correct? So these are the maximum limits which we have worked on based on the assumptions which I have discussed with you. So that completes the first set of discussion with respect to the personal tax rates, right? Going to the next set of amendments from budget 2025, they are in the limits of TDS and TCS. Government has been very liberal in giving this expansions in the scope of TDS and TCS. To start with, TDS on payment of income by securitization trust to resident individuals and HUF investors. It was 25% for individual investors, 30% for HUFs. It is proposed to be brought down to 10%. Again, very few cases will deal with this. Now, annual thresholds for a resident payee with effect from 1st April 25. So, TDS on interest existing, there was no limit. Even if I was paying 100 rupees as interest, I was deducting TDS. Now, there is a limit of 10,000. Interest other than securities, presently for senior citizen it was 50,000. They have increased it to 1 lakh. For other than senior citizens, it was 40,000. Now they have increased it to 50,000, wherein the payer is the bank, cooperative bank, or a post office. In any other cases, if you are paying interest other than securities, 5,000 was your limit. Now they have increased it to 10,000. Coming to DDS on dividend. So before the limit was 5,000. Now they have increased the TDS limit to 10,000. So only if you are paying more than 10,000 as dividend, you need to do TDS. Coming to TDS on income from mutual fund units, they have increased the limit from 5,000 to 10,000. TDS on insurance commission or other lottery commission or any other brokerage or commission, they have increased the limit from 15,000 to 20,000. So basically in Finance Act 25, they have also reduced certain TDS rates, and the TDS on commission was one of those, wherein the TDS rate was decreased from 5% to 2%. TDS on professional or technical services or royalty for non-compete fees, the present limit was 30,000. Again, they have increased it to 50,000. TDS on compensatory for compulsory acquisition of land, the limit was 2.5 lakhs. Now they have doubled the limit to 5 lakhs. So these revised limits will be applicable from 1st April 2025. Other thresholds, if you talk about, the existing structure was if you are paying rent of more than 2,40,000 a year, you need to do TDS. Now they have changed the limit, they have widened the scope. In the market and even in the budget speech, madam had made a mistake wherein she stated straight away that up to 6 lakhs there is no need to deduct TDS, but that is not how the law is written. In the law, it is written that if you are paying 50,000 per month or part of the month, if you are paying to somebody in excess of 50,000, if you are paying it to somebody, paying rent to somebody, you need to do TDS. So what is the implication of this? Previously, for the total year, the limit was 2,40,000. Only when I crossed 2,40,000 for the entire year, then I should have done TDS. Now the limit is not like that. Even if I am making a payment of 65,000 for a particular month to somebody, I need to do TDS. So they have brought in more persons under the purview of TDS on rent. Previously, it was 2,40,000 for the entire year. Now the madam said in her speech that it is 6 lakhs limit. Ideally, it is not 6 lakh. They have brought down the limit to 50,000 a month. So even if I'm making a payment of 55,000 as rent to somebody, now I have to deduct TDS. Very important. Very in the social media and all, people are misguiding on this limit. Next, TDS on winnings. Before before the limit was, if I'm earning more than 10,000 for the entire year, only then TDS was applicable. Now they have changed that limit to 10,000 per transaction. So any other online game or puzzle or lottery, what was the limit? It was if I'm earning 10,000, more than 10,000 for the entire year, only then TDS was deducted. Now for a single transaction, if I'm earning more than 10,000, then TDS gets deducted. Again, they are widening the base. Coming to TCS on LRS remittance scheme and overseas tour package program, wherein you are sending money outside India under the liberalized remittance scheme, that too through in the form of overseas tour package program. Previously, the limit was 7 lakhs. Now they have increased the limit from 7 lakhs to 10 lakhs. So these are the TDS rates. To proceed ahead, there are some provisions which are rationalized with effect from 1st April 25. The first one being, previously there was, even though I am sending money outside India for education purpose and that money I had taken as in the form of loan, even on that money TCS was collected. Now they have done away with this requirement, so there is no requirement to collect TCS on LRS remittance by way of loan from financial institutions for education. Good, because whenever I've taken money for education and I'm sending it out, TCS component would impact my working capital there. Now that issue is resolved. Now, very important amendment, TCS on sale of goods has been done away with. So there was a provision wherein section 2061 said that if I'm selling goods of more than 50 lakhs, then I need to collect DCS. Correspondingly, there was a TDS section 194N which said that the other person is buying goods, you need to do TDS. So there were two provisions, conflicting provisions which had come in, I guess, 2 years back. Now the TCS provision, wherein even though if you are selling goods more than 50 lakhs, you need not do any TCS, you need not collect any TCS. Now only 194N shall continue, the rate shall remain same. Again, there was a provision earlier wherein if I am making any like if I'm making payment of any TDS and TCS and the other person, the deductee or the collectee, had not filed their income tax return, then it was my obligation to deduct TDS or collect TCS at a higher rate. So if I had to make payment to someone, I need to ensure that the other person had filed their returns promptly. That provision was practically very difficult to implement, because how would I know whether the other person has been filing his income tax returns? So considering this practical difficulty, the government has taken away this provision. So in this case, even though the other person is not a regular filer of income tax return, still TDS need not be deducted at a higher rate. However, the other provision wherein the deductee or the other person does not have a PAN or has an invalid PAN, I need to deduct TDS at a higher rate, that provision continues to stay. Only the cases where the other person is a non-filer, that enhanced TDS limit has been brought down. Coming to delay in TCS collected, so there was a provision wherein if I have collected TCS and I have not deposited it to the government beyond a specified date, the offence was a criminal offence, wherein prosecution was there. Now they have decriminalized it. Again, it is a welcome move. Going ahead to the next set of amendments. Yeah. So the next area of amendment is under the head salary. So there is a provision which says if an employee is earning more than 50,000 a year, then whatever facilities like I give as an employer, I give. Say it is a motor car facility or a transport facility or a free servant or free electricity or gas or water, whatever any perquisite that I give as an employer to my employee, and if my employee's gross salary is more than 50,000 per year, then it will be taxable in the hands of employee. This is the existing provision. This limit of 50,000 per year salary was set way back in 1993 and it needed a upward revision. So the government has now empowered itself to set this at a higher limit. The higher limit is yet to be notified by the government. This is the first amendment under salary. The second amendment is, as an employer, if I incur any expenditure on the foreign travel of my employee for the purpose of medical treatment of my employee or his family member, and the gross total income of my employee is greater than 2 lakhs, then whatever I spend for this travel, it becomes taxable in the hands of employee. Again, this limit of 2 lakhs was set way back in 2001 and again it needed a revision. So the government has empowered itself to increase this limit from 2 lakh to a higher amount. Again, we need to take care that this 2 lakh is only with respect to the travel. Whatever amount the employer is spending on treatment and stay, that will be exempt to the extent permitted by RBI. There is no amendment in that. Only for the foreign travel, there was a limit of 2 lakhs. That 2 lakhs they are proposed to increase. Again, this is only applicable to a outside employee. If it is this revised limits which the government is yet to notify will not be applicable in case of a director employee or an employee who has substantial interest in the company. So this is the amendment under the head salary. So under the head house property, we have an option to declare two house properties as a self-occupied property and we need not pay any tax. If I have three houses, I cannot, one house will be treated as a deemed to be let out property. If it is a let out property, then absolutely it is a taxable income. But if I have three properties, then one property would be deemed to be let out property. And for me, the other two, I can claim maximum two houses as a self-occupied property. That it is my house, I have not given it on rent. So there was a condition that if I had two houses, if I have want to claim this benefit, that I should not have occupied that the other house only because of my business profession or employment. So this was the condition. So if I want to claim it is a self-occupied property, then I should not be staying in that house only because of my employment or my business or profession. Now they have changed that. They have removed that. Now, if I have two house properties, if I want to claim the benefit of two SOPs, two self-occupied house properties, for whatever reasons, if I'm not staying in that house, I can claim this benefit. Earlier, the law was I can claim the benefit of SOP only if I'm not occupying that house because of my employment or my profession or my business. Now they have changed, for whatever reason, if I'm not using, up to two houses I can claim as a self-occupied property. Again, a very welcome amendment. To proceed ahead, what are the changes in the income tax return? The government is very intelligent. They have increased the time limit for you to file an updated return. So updated return can be filed by any assessees. This also came into picture from 2 years. So earlier the law was I can file updated return only for 2 years after the end of relevant assessment year. Now they have increased it to 4 years. So even after 4 years, up to 4 years, I can file my updated income tax return. Then what is the use of giving timelines, strict timelines? The benefit is that there are certain conditions only under which you can claim updated income tax return. To summarize it in a short way, you cannot file an updated tax return for your own benefit. Updated income tax return can be only filed for the benefit of the department. In other words, if I want to increase your refund, increase your losses, claim any additional expenses, no, you cannot file. You are not allowed to file an updated return. However, if you want to declare more income, if you want to declare more taxes, then updated return option is available. Earlier, it was available for 2 years, wherein if you are filing it within 1 year from the end of the assessment year, you should have paid 25% additional tax, 25% of interest and tax. Interest and tax, whatever would be your normal liability, on that you had to pay 25%. If you are doing it within 2 years, then you have to pay 50%. If you are doing it within 3 years, now this is the amendment. Earlier you could have done it only for 2 years. Now you can do it for 3 years, and if you're doing it for the third year, then 60% of tax and interest which you need to pay as an additional tax. And if you are doing it up to fourth year, like after third year but up to fourth year, then you need to pay 70% of additional tax, 75% of tax and interest. So again, the government claims that trust first, scrutiny later. Because of this, they are giving you an option to file your updated income tax return up to 4 years from the end of relevant assessment year. Again, one catch is that in such cases it is not allowed, and there is a provision wherein you get a notice for income assessment, that is 148. So if you get that after third year, until and unless that case, that assessment proceeding is dropped, income escaping or reassessment proceedings is what we call, until and unless that proceeding will get dropped, you cannot file an updated return for the fourth assessment year. So this is technical, just to make you understand. In such cases it is not applicable, and in specific cases wherein you have got a notice under 148, 148 is the income escaping assessment or a reassessment, what we call. In that case, if you have got the notice, until and unless that those proceedings are dropped, you cannot file the updated return for that income. So 139(8) is the governing provision for this. To proceed with the next amendment. So next amendment is under the head capital gains, wherein ULIP. ULIP is a unit linked insurance policy, and the government very recently had come up, like these limits were there. Government started taxing this very recently. So what was the condition? If normally whatever insurance receipts you get, that gets exempt subject to certain conditions. The condition is that your premium should not be more than 10% of your sum assured, and the second condition which the government had recently introduced, the premium of the policy should not exceed 2.5 lakh and 5 lakh for other policies. So if you meet these conditions, whatever are your proceeds, those get exempted. But if you don't meet these conditions, for example, if your some premium amount exceeds 10%, or your total premium exceeds 2.5 lakh or 5 lakh, as the case may be, there are certain due dates given, those date calculations are there. If you breach this, then your income gets taxable. Now the question was, it was very clear that if you don't meet these conditions, whatever are your insurance receipts, they are taxable. The question was under which head. So there was no clarity. Now they are bringing clarity to it, and they are taxing this under the head capital gains. Now whatever are your receipts from ULIPs, unit linked insurance policies, now they'll be treated as a equity oriented funds, and they'll be taxed under the head capital gains. Again a welcome amendment, because if it is a capital gain, and if it is a long term capital gain, you can get an exemption of 1.25 lakhs. So only in excess of 1.25 lakhs you need to pay tax. Again a very welcome amendment. In other cases, what would have happened is it gets taxable under the head income from other sources, wherein you will not get this benefit of 1.25 lakhs. Again a welcome amendment. Let's proceed with the next amendment. Again, as said, long-term capital gain was earlier from the share market was earlier taxed at 10%. From July 2024, they have revised the limits from 10% to 12.5%. This they had missed to do it for non-residents. So again, now they realized it, and they are increasing the limit from 10% to 12.5%. So long-term capital gains, even for non-residents, it is getting taxed at the rate 12.5%. Next, deductions. The government is giving certain deductions also, which is for their own benefit, if you know why. So NPS Vatsalya scheme is a scheme which they have introduced very recently, and they have included this under section 80 CCD 1B. So this is a scheme wherein the governments want you to invest money for your minor child, until they attain majority. So in this, the overall limit under 80 CCD 1B was 50,000. In this, either you can invest it. 80 CCD was your national pension scheme. So under 80 CCD, either you can invest in national pension scheme, the normal one, or the Vatsalya scheme. Vatsalya scheme is for the minors. So again, the overall limit under 80 CCD 1B is 50,000 only. Correct? And whenever you withdraw this amount, it would be taxable. Whenever you withdraw this amount, it will be taxable. Whatever the principal and interest, it will be completely taxable. However, if you remove this amount on account of that, it will not be taxable. It will be exempt. And for partial withdrawal, in certain cases, 25% would be taxable. Sorry, 25% would be exempt. 75% would be taxable. So again, NPS is a scheme which you may think of to claim deduction under 80CCD 1B. Again, be mindful, friends, 80CCD 1B is not available under the new tax regime. 80CCD 2 was the only thing that was available under the new tax regime. 80CCD 1B is not available. However, they were giving this, they are promoting this as an this one as an employee. As an employer, you can do that, right? 80CCD 1B. National Savings Scheme, this was the old scheme against which the government stopped giving interest on that. So obviously, if it is not earning any interest, people want to withdraw this money. If you are withdrawing this money on or after 29th August 2024, then whatever money you withdraw from this becomes exempt. So National Savings Scheme is an old scheme. Maybe your parents, like senior citizens, would have this. It got stopped long back, and the interest accrual got stopped very recently, and only because it is not earning interest, people have to withdraw this money, and whenever they withdraw this money, they are making it exempt. Coming to the next one, there is a provision called 80IAC wherein eligible startups get a tax holiday of 3 years out of 10 years. So if they get the interministerial certificate. So for that, the eligibility condition was the startup should be incorporated between 1st April 2016 to 1st April 2025. Now they have increased that limit to 1st April 2030. So if you have a startup and if you want to claim this 80IAC benefit wherein for 3 consecutive years out of 10 years, you can pay zero tax. You will get tax holiday on your business income. So practically what we see is that it is very difficult to get this interministerial certificate. Proceeding with the next set of amendments. So business trust. So business trust, normally few what status was given to business trust. Business trust, when I say business trust, it is basically REITs and InvITs, real estate investment trust and infrastructure investment trust, wherein dividend, interest, all other incomes would like the business trust had a pass-through status, wherein the income would have been ultimately taxed in the hands of unit holders. But apart from few incomes, the other incomes would have been taxed in the hands of business trust only, but at as a maximum marginal rate at MMR. Now they have curbing this. Now they want to rationalize this, and whatever income, if it is in the nature of capital gains, it is getting rationalized at 12.5%, not at MMR, maximum marginal rate. Again, a welcome amendment. Coming to charitable and religious trust, again a very important amendment, wherein if you have a charitable or religious trust wherein the turnover, wherein the income for the previous 2 years, both of the preceding 2 years is less than 2 crores, then when you go for re-registration, normally what is the prevailing law? The validity of registration is 5 years. So if you are a small trust wherein for the last 2 years, preceding 2 years, your income was less than 5 crore in each of the 2 years, then whenever you go for re-registration, the re-registration would be given for 10 years. Earlier, every 5 years you need to go and renew, but now you can go once in 10 years. So the re-registration limit has been increased from 5 years to 10 years. Please note that this is only applicable for re-registration. If you're going for a first time registration, again an initial limit of 3 or 5 years as the case may be will apply. Again a very welcome amendment. Next, proceeding ahead, again a very important amendment. So what was the provision? I'll tell you the provision. So there is a provision which says that if you do any specified violations as a charitable or religious trust, if you do any specified violations, then whatever is your accreted income is the market value of your net assets, get taxable at the rate 30%. So this was a very harsh provision wherein the definition of specified violation included a point: if your application for this charitable and religious trust status, in that application if you have done any mistake, that would also get covered under the specified violation, and it would lead to cancellation of your registration, and cancellation of registration will attract tax on your fair market value of your net assets. So that was a very harsh provision, and officer was invoking this only for minor defaults. Now they have removed, if your application is incomplete, then specified, it is not treated as specified violation and your registration will not get cancelled. Again a very welcome amendment which will stop harassment to the taxpayer. So again, new thing, what would be a substantial contributor? So there is a thing called substantial contributor. As a business or religious trust, if I'm making any expenditure for the benefit of a substantial contributor, then against that I will not get any benefits under section 11 and 12. That is, that income will not get exempted. So who is a substantial contributor? What is the question? Earlier the limit was 50,000. If I'm making 50,000 contribution to a trust charitable or religious trust, then I was considered to be a substantial contributor. Now they have revised this limit. Now if I want to be considered as a substantial contributor, either I need to give a contribution of 1 lakh during the financial year, or aggregate throughout the life of the this one I should have given 10 lakhs. So in a year, if I give 1 lakh or more, then I will be treated as a substantial contributor. In a year, if I've not given 1 lakh, but aggregate up to the financial year, if I've given in total, if I've given 10 lakh, not just in this financial year, in all the financials here put together, if I've contributed 10 lakhs or more, then I'll be called as a substantial contributor. So the limit has been increased from 50,000 to either 1 lakh per year or in aggregate 10 lakh. Further, the existing provision said that my relative or the concerns in which I hold a substantial interest will also be considered as a substantial contributor or as a related party. So again, this is removed. So even though I am a substantial contributor, my relative or the concern in which I hold substantial contributor will not be treated as a related party. So what is the provision? If I make some expenditure which for the benefit of a related party or substantial contributor or his related party, then benefits of section 11 and 12 are not available. Now they have removed the relative and the concern in which I have substantial contribution from the definition of related party. So now even though I am a substantial contributor, my relative will not be considered as a related party. So this is again a welcome amendment. Proceeding to the next amendment. Taxation of non-resident and international taxation. So again, very welcome amendment. Government to promote electronic manufacturing facilities in India has come up with a new presumptive taxation scheme for non-resident, wherein non-resident providing services or technology for setting up an electronic manufacturing facility to a resident company fulfilling the prescribed conditions. So this is applicable only when you are giving services or technology for setting up an electronics manufacturing facility to a resident company, not to all assessees. And that resident company should also fulfill prescribed conditions. In that case, 25% of that non-resident's turnover would be treated as the profits. So as such, for individuals, how you have 6 and 8%, like this, 25% would be treated as your income. Effectively, what would be the impact? The effective tax rate for these companies will be less than 10%. Again, this will come into force from 1st April 26. Again, this is specifically to boost a specific sector, that is electronics or semiconductor sector, wherein if a non-resident is providing services or technology for electronic manufacturing company, resident company fulfilling the specified conditions, then out of your total receipts, 25% would be treated as your profit, and effectively the tax would be 10% of your total receipts. Again, a very welcome amendment. Proceeding ahead, taxation. So again, this is also a very important amendment, wherein if I'm a non-resident, if I purchase goods only, like if I'm a non-resident and I purchase goods in India only for the purpose of exports, then that income would it would have been deemed to arise in India. Now they have changed this. Now if I'm a non-resident and I'm buying goods from India only for the purpose of exports, then such income will not be deemed to accrue or arise in India. So normally, even for a non-resident, any income accruing or arising in India will be taxable. But this was a provision which had some lacuna in it, wherein if I'm a non-resident, I am purchasing goods in India only for the purpose of exports. That income earlier used to be as an income earned in India. Now they have excluded that. So if I'm a non-resident purchasing good only for the purpose of export, it will not be taxed in India. Again, a very welcome amendment. Proceeding to the amendments in transfer pricing. So earlier, transfer pricing applies to specified domestic transactions or international transactions, wherein if the AO wants the help of transfer pricing officer, he can refer the case to the transfer pricing officer, and the transfer pricing officer will determine the arm's length price of a particular transaction. Now what would happen is that every year for the same transaction, the AO used to refer to the transfer TPO, transfer pricing officer, and it would be a time consuming activity. Now the government has come up with a scheme wherein it is if I go and get a transfer pricing report for a particular transaction, and even for the next year I am in the effect of the same transaction. So whatever was the transfer pricing report which I had got earlier, now it will be valid for the year in which I have obtained it and plus 2 years. So in total, whatever the TP assessment is done by the transfer pricing officer, now it will be valid for a period of 3 years. Earlier, every year I need to go to the transfer pricing officer and get it done. Now it is once in only 3 years. Again, a very welcome amendment. Again, this is an amendment which has clubbed a loophole in the law, wherein what did the law earlier said, in case of amalgamation or business reconstruction, whatever was the losses of the amalgamating entity to the amalgamated entity, they can be carried forward for the period of 8 years from the date of amalgamation. So this was the law earlier. So I had some losses, I got merged, say for example after 5 years. Now again those losses gets carried forward for 8 years. Again say after 6 years I get merged with some other entity, again those losses will get carried forward for next 8 years. So this was the lacuna in the law. There was a loophole. The government has plugged this loophole and said the losses even in case of amalgamation will be carried forward by the successor entity only for the period of 8 years wherein the loss was first incurred. So earlier it was I incur a loss. Now whenever I get amalgamated, next I'll get it for 8 years. Whenever I get amalgamated, the loss will get carried forward for 8 years. Now they have removed it. The loss will get carried forward for 8 years, not from the date of amalgamation, but from the date of the incurring of that loss. So up to 8 years from the original incurrence of the loss, not from the date of amalgamation. Again, this was a lacuna which they have clubbed in now. Now crypto assets, there is a major amendment wherein government will prescribe certain authorities who have to who are dealing in crypto assets. They have to give certain information to the income tax department, which will again get reflected in your AISTS, like how your dividends, your share market income, your bank interest is already coming and sitting in your AISTS even before you file your income tax return. Now crypto information will also come to the department even before you file it. So better to disclose all your crypto assets well in advance, because there is a corresponding amendment in the block assessment chapter wherein they have specifically included crypto assets as an undisclosed income. So be mindful, if you have crypto assets, please declare it in your income tax return. Coming to the last aspect wherein I have taken a very important thing from GST. I'm not, so to start with, there's a landmark case wherein plant or machinery, wherein the input on building, it was given in Safari retreats. The Supreme Court had held, it had allowed ITC, but now as said, the nature of this government wherein they lose a case in the Supreme Court, they amend the law with retrospective effect, overriding all the case laws. Now they have replaced the phrase plant or machinery with plant and machinery retrospectively from 1st July 2017. So the case wherein in the Safari retreats, whatever the judgment was given by the Supreme Court, that has been overruled now. You cannot claim ITC on immovable property, which is blocked under 17.5D. Again, there is okay. Coming to the next amendment, if supply of goods warehoused in SEZ or free trade zone to any person before clearance for exports or DTA shall be treated as neither as supply of goods nor as supply of services. So I'll tell you what happens is, in case of exports, the goods are stored in SEZ warehouses, and if the movement of goods between those warehouses, now they have been exempted from GST. They are neither treated as supply of goods nor they are treated as supply of services. Again, a clarification is given in this regard. Whatever taxes you have already paid, you will not get refund on this. Now this is, even though this is a retrospective amendment, you cannot go and ask for a refund. So whatever movement of goods between the warehouses at the time of before export, so that will neither be treated as supply of goods nor it will be treated as supply of services. But again, a refund will not be given if you are a prompt taxpayer, and if you already paid tax on such a supply, you will not get refund. Coming to the next amendment wherein there was a lot of confusion regarding taxability of vouchers. Now the government has omitted, sorry, yeah, sorry. So vouchers will be considered as actionable claims. So as on 31st December 2024, it was clarified that voucher will neither be treated as supply of goods nor it will be treated as supply of services. It will be treated as an actionable claim. So only when I redeem that voucher, the supply will get tracked. So to give effect to this, the time of supply of vouchers, that provision has been removed from the law. Again, very simple amendment. Then comes a very important amendment wherein reduction in liability on credit note not permitted if ITC availed has not been reversed by the recipient or tax incident has been passed on to any other person. So what happens is I do a sale, the recipient gets claims input tax credit. Now when I generate a credit note, so my liability for this current month will get reduced, and it is the responsibility of the recipient to reduce his ITC to that extent. So to enforce this even more effectively, the government has come up with this wherein if I'm raising a credit note, it is my responsibility to ensure that the other person is also reversing his ITC. Because when I make a sale of 100, I give you 18 rupees credit. So you take that credit of 18 rupees. When I raise a credit note, say for 50 rupees, now I am paying 9 rupees less liability to the government, and it was my recipient liability to reverse that 9 rupees in his from his input tax credit, which was not being done. Now the government is making it very strict. Whenever if I want to reduce my liability when I issue a credit note, the corresponding recipient should also reduce his ITC to that extent. Next, pre-deposit of 10% penalty amount before filing the GST appellate authority. So whenever you have to go for an appeal, there's a limit. You need to deposit certain amount, and only then you can proceed with that challenging that in the appellate authority. Now that limit pre-deposit is 10%. Coming to a last amendment for the day, which is very important. This is with regards to GSTR 2B. So earlier what happens was that GSTR 2B was a static statement wherein the government would generate GSTR 2B on the basis of GSTR 1 filed by the suppliers. They used to generate and give it, which was a static report. Now, which was an auto-generated report. Now, since IMS has kicked in, what is IMS? IMS is a mechanism wherein all my purchases are getting reflected on the portal, and I should reconcile them on the portal even before generating 2B. So if they are my invoices, I need to accept. If those are not my purchases, I need to reject. If I want to keep something on hold because of there are any clerical issues or maybe some calculations issues, I need to keep it on hold. Only when I do this exercise, my 2B gets generated. So they have made an amendment saying that since your GSTR 2B earlier was an auto-generated statement, now they have removed the term auto-generated. So now they say your 2B is not auto-generated. 2B is not what we are giving you. 2B is something which you are creating on your own self based on the information we are giving you through IMS. So what is the impact of this? Basically, government wants to say that whatever input you are claiming it on your own responsibility. So what was the general tendency? The general tendency was that whatever was appearing in 2B, we used to claim that input. And whenever we get notice, we used to justify saying that, okay, it is appearing in 2B, that is why I have claimed. Because see, appearing in 2B is not the only condition to claim input tax credit, right? There are other conditions also. To curb this, wherein the department was losing cases in the court of law for this, because only because you have given me in 2B, I used to claim that 3B. Now what they are doing is, I will not give you ready-made 2B, you generate your own 2B. So this is again a very important amendment from GST perspective. So these are key amendments which I have tried to discuss. There are other amendments also specifically related to IFSC, International Financial Service Center, which is in Gift City, Gujarat. Those amendments have not taken up. There are also other amendments with respect to the penalty provisions, wherein certain penalties the power has been given from higher level authorities to lower level authorities, and some limits are also revised and some timelines are also revised, which I have not taken up in this session. So those are also amendments which are relevant but which I have not covered because they are not useful in the day-to-day life. I've tried to take those amendments which are more useful to us. So if you have any queries, we can discuss all these amendments. Please ensure that this is just a finance bill. This has to be presented before the parliament, which is being done now, and the president will sign it. Only then it becomes a finance act. Only when it becomes a finance act, then it gets applicable. Finance bill, this is just a bill, this is just a draft, this is subject to change. Please be aware of this fact. I hope you will have a good day. Take care.